My name's Melinda Young, Director with Bekaert. Our final session of our virtual conference is centered around state credits and incentives. We will talk about ways you can identify and optimize these credits and incentives benefits. I would like to introduce our Bekaert speakers. Joining me today, we have Nick Kuzno, Senior Manager in our Greenville office, and Robert Roeder, Senior Manager in our Houston office. In this session, we will talk about different types of credits and incentives. Robert will discuss discretionary incentives, and Nick will discuss statutory credits. We will share our experiences working with different C&I programs, and also run through some of the new programs that became effective this year. Lastly, we'll talk about what questions to ask when we're looking for C&I opportunities, and also what information will we review when we're quantifying potential benefits. State and local government offer tax credits and incentives to attract businesses to expand in their areas. Whether it's capital investment or job creation, these incentives will shield them from the impact of high tax rates and help them increase their return on investments. Did you know state and local government gave out an estimated $95 billion a year in business incentives? When you think about tax incentives, there are 5 major categories. There are job credits, investment credits, R&D credits, wage rebates, and property tax abatements. For financial incentives, we think about cash credits and low interest financing. So altogether, there are more than 2,400 state and local incentive programs out there. Just to break it out by different types. So about 28% are related to tax credits, about 24% are grant, and 20% are loans, and 18% are tax exemptions. So if you look back in 2022, the site selection group identified more than 1,700 incentive programs out there, packages out there, with a total value exceeding $24 billion. From these packages, companies are expected to invest about $260 billion and create more than 290,000 jobs. And this results in a 9.3% of return on investment, averaging about $84,000 per job. And also the average award is about $13.8 million per project. So these numbers are actually a little bit skewed because there were a lot of large projects last year in 2022. There were some semiconductor projects and also EV battery storage projects. So more realistically, if we back out these mega projects, we're probably looking at about 8.2% of ROI and about $39,000 per job, and also an average award of $5.8 million per project. So with so many incentive packages out there, did you know an estimated 50% of them go unclaimed every year? I mean, that number is so shocking to me. This number has actually gone down quite a bit for the past 10 years. It used to be about 80%. So personally, I think it's because Amazon HQ2 search has helped us educate a lot of people about credits and incentives, and it has become part of a company's decision-making process. Nick, why do you think these incentives would go unclaimed every year? It's almost like, it's getting free money from the government.
Thanks, Melinda. Good afternoon, everyone. Yeah, it is like passing up free money from the government, although to compound the loss is many companies are paying professional and legal fees up front to qualify for these incentives, not to mention all the employee time spent initially pursuing these incentives as well. So C&I monies may go unclaimed because the company does not meet the investment or job requirements, sometimes due to poor planning and negotiation, or it could be something as simple as a change in the economy or business environment. There are often annual reporting requirements with hard deadlines the taxpayer must be mindful of and meet in order to claim C&I monies. And if these are not met, they're going to lose the opportunity to do so. There are also situations that we have witnessed where there's poor communication between the taxpayer's tax planning and compliance team, especially when there are multiple third-party advisors involved, and then with the corresponding economic development office handling the incentive. The more parties that are involved, the more difficult it naturally is to coordinate all the C&I compliance and reporting requirements. So working with a dedicated credit and incentives team to quarterback all the parties is really key to success with any tax incentive. And it's something we pride ourselves on here at Bekaert. Employee turnover and succession planning can also result in the loss of easy money. Depending on the length of the incentive program, a key employee, let's say the CFO who negotiated the deal, is no longer with the company 5 years later when the incentive is to actually be realized. If there wasn't a good documented handoff of the incentive projects, the company will likely not even realize that it was in an incentive program at that 5-year date later in time. Similarly, changes in long-term employees of the state or economic development offices can also result in the loss of institutional knowledge in which a newer replacement is not familiar with your company's specific incentive package. And then just more generally, if there's a change in the political climate or business environment, the taxpayer may be unable to claim tax credits and incentives depending on the length and type of the program. So Melinda, these are kind of all the reasons why incentives go unclaimed and companies miss maximizing their benefits.
That makes sense. Thank you, Nick. So now you're probably wondering, where are the incentive money coming from? I mean, $95 billion is a lot of money. So the money is actually coming from collection of state tax revenue. In 2021, state government collected $2.1 trillion of state tax revenue. And about 32.8% is coming from sales tax and gross receipts tax. About 30% is coming from property tax. Another 30.6% is coming from income tax. And within the income tax bucket, about 85% of that is coming from individual income taxes. So we compare these numbers to 2022, property tax collection have actually decreased due to employees working from home and companies shrinking their physical presence. Therefore, sales tax and income tax have gone up quite a bit. So who can guess the top 5 states that collect the most tax revenue? Robert, what do you think?
Oh, let's go with Texas.
Great guess, Robert. Texas is in the top 5. So number 1 is California. They collected $280 billion. Number 2 is New York, $117 billion. Number 3 is Texas at $82 billion. Number 4, Illinois at $62 billion. Number 5, Florida at $59 billion. That's a lot of tax revenue from all these states. It would give them the ability to incentivize growing businesses. So if you further break out incentives funding by industry, you'll notice that manufacturing is going to top the chart every single time. It's because incentives are typically based on capital investments, which would go onto your property tax row, and job creation and retention, which will increase your consumer spending power, which leads to more sales tax collection. And also you will be subject to income tax in most states. So currently there are about 9 states that do not impose a state income tax. And it's very interesting to see that Texas and Florida are in the top 5 because they don't have any income tax, but they do make it up with collecting a lot more property tax and sales tax. So we're looking at the top 25 projects in 2022, which accounted for about 77% of total incentives awarded. These projects are committed to invest $168 billion in investment in creating more than 62,000 jobs. And the ROI is around 11% with the average award close to $300,000 per job. Also note that in the top 20 projects are all manufacturing projects, so no surprises there. Comparing all states, Ohio announced the most incentive project in 2022, landing a couple of really exciting projects, including Intel and Ford Motor. So I threw out a lot of big numbers here. So let's talk about what programs make up these numbers and what are the triggers for these incentives. So C&I has been a very hot topic recently with the new renewable incentives under the IRA, Inflation Reduction Act, the CHIPS grant for the semiconductor industry, and also as companies recover from the pandemic. The state and local government have been very active in responding to all these new changes. So here are some triggering events for C&I opportunity, whether it's expansion or relocation, creating or maintaining jobs, making investments, or hiring individuals from certain targeted group, investing in ESG or R&D. These are all potential target for C&I benefits. Nick, can you share some recent expansion or relocation projects we have worked on?
Yeah, I can give 2 good examples of client success we've had in the last year. So the first is a manufacturer located in Georgia who's been expanding their operations slowly over the last few years and then aggressively in the last year or so. This company has been in business for a long time, and they are investing heavily in upgrading and modernizing their equipment and facilities. And coming out of COVID, I can imagine that there's a number of companies looking to do the same. So based on their location in Georgia and the county designation, the company is eligible for the Georgia Investment Tax Credit. We'll get into some more of the mechanical details later on, but this credit is calculated as a percentage of the new asset's original tax basis. In this company's case, it was 5% of their tax basis is basically equal to the credit. There is a credit pre-approval process and subsequent filing with the income tax return, and we are able to help the company navigate through both of these. This company has been earning Georgia ITC, as I mentioned, for a number of years incrementally, while also eating through some of its net operating losses. But this last tax filing, the NOLs have been all used up, and we were able to save them over $1 million of Georgia income taxes with this credit between this year and their upcoming filing. The other example that I'd like to highlight is a company that located a few years ago from Tennessee to South Carolina. This company is a distributor and also does some light processing and manufacturing. They were working with another public accounting firm at the time of the move, and that firm was not taking advantage of any of the South Carolina tax credits that the company is eligible for. So we identified a number of opportunities for the company, including the South Carolina investment tax credit, the jobs tax credit, and the port volume credit. So we were able to generate significant amount of jobs tax credits because this company, the way the credit's calculated, you basically start with a base year of 0 because they had no presence in South Carolina, and all the jobs that they moved here from Tennessee were eligible for the credit. So they went from 0 to 30 in that first year of relocation. I mentioned that they were with another firm at the time, so we were able to actually go back, thankfully, and amend 3 years worth of returns for them in order to claim the credit and capture that full value. Robert, do you have any other insights to share on companies that have recovered from the pandemic?
Yeah, thanks, Nick. A few things to mention dealing with the Georgia jobs tax credit. So during the COVID era pandemic, there was a policy that came out where you could use your 2019 headcount for 2020 and 2021's JTC calculations. Now, starting in 2022, that policy did expire, and you're no longer to use your 2019 headcount. You have to use your actual 2022 headcount in your calculation. Another thing to bring up is the opportunity zones expired. There's quite a few within Georgia that expired. Some were new ones have been replaced. But for the ones that are expiring, a lot of people are thinking that they're no longer able to claim the credit, which is not true. You still have the installment piece of the credit that you're able to claim. So that could last out for another 4 years for the jobs that were created within the OZ during your last year, like 2021, if that's when it expired. And then here we want to talk about the stakeholders in your incentive project. So working in an incentives projects, there's a lot of people involved. This can be anywhere from payroll, human resources, to real estate, your tax compliance, your planning. A lot of people is involved, from the CEO, the CFO. So here at Cherry Bekaert, how we can help with that process is we can identify the key stakeholders within the incentive projects. And then what we do is we align the goals with each of those units, and we'll help them communicate with each other. And then we'll develop a timeline and assign responsibilities to each other. So when dealing with a lot of the incentives, there's a lot involved, mainly with timing that has to take place. And we don't want, for instance, government affairs to be releasing announcements when they should not be. And then same thing as we're negotiating with localities or with the state, we may need the real estate group involved, legal involved, and then also human and resources, our payroll, to provide us information. And then here we'll jump into a little bit of discretionary incentives. So one thing we want to mention is some new incentive programs for 2022 and 2023 that came out. So New Jersey came out with a manufacturing voucher program. So this program will provide grants to New Jersey manufacturers for the purchase of equipment that they need to improve their operations. Grants are awarded under this program will be equal up to 30 to 50% of the cost of eligible equipment. and also includes the installation, and the maximum award is up to 2,500. I'm sorry, 250,000. Another incentive that we want to mention is the Investment Illinois Act. So what this does is provides incentives and ready access capital to encourage and promote the retention and the expansion of existing businesses in the industry and within Illinois to attract new businesses in different industries to the state. These are non-competitive economic incentive awards, such as grants, loans for the company for making the capital investment and creating new jobs or retaining jobs within the state. Another incentive or grant that we want to announce that came out recently in 2023 is the Virginia Cloud Computing Cluster Infrastructure Grant Fund. So what this is qualified companies are eligible to receive a grant payment for each year beginning in 2025. And the amount of the grant is based off of your qualified companies, their actual investment, and also the number of people that they hire. So the new headcount that you're creating. And then last, we would like to announce the Kansas Apprenticeship Act. So what this does, it provides tax credits and grants for eligible in-state businesses and for-profit eligible healthcare employers. So typically, a lot of healthcare does not qualify for stuff. In this case, it would underneath the Apprenticeship Act. So this is effective starting for tax years beginning after December 31st of 2022 and will end in January 1st of 2026. The credit or / grant is going to be equal to about $2,500 for each apprenticeship employed, and it's capped at a 20 apprentice employed for each taxable year. And then here we like to talk a little bit about the life cycle and incentives. So you heard me mention about the different type of people involved, the stakeholders. Well, it's really important that if you are going to get someone involved with this incentive project, it happens before any type of announcement is publicly made. So typically 6 to 8 weeks in advance, you would want to bring us in, and that way we can help start looking at the different programs that are available at the different locations you may be interested in. It runs 30 to 60 days typically for us to start the process and start negotiations with the different localities in the state. And then these negotiations can take up to 60 to 90 days, just depending on the players that are involved. Once the negotiations have been settled, it's 60 to 120 days for us to actually implement the process. And then you do have the compliance that could be tied to your different incentives. And that would be anywhere between 5 to 10 years, depending on the package that you have and the type of incentive. The main thing here is for any of us to be involved with this, it has to happen before any type of public announcement is made, because once you announce that you're either going to be expanding to a location, or if you're going to be creating, a new expansion, new jobs, the state doesn't have an incentive there to actually give you anything. So it's imperative that we're involved before the announcement is made. Melinda, any insights into the negotiation process?
Sure, Robert. It's always very important to strategize your approach when you are negotiating with multiple jurisdictions. So like Robert said, you want to identify the right stakeholder and also work closely with the economic development agencies, get to know and develop a relationship with the decision makers at every jurisdiction. If you're talking to the county, get to know the county judge or the county commissioners, and don't be shy in asking them to support your project. You want to review the city's, the county, the state's economic development plan, then align your goals with their goals to make the negotiation and the project successful. As Robert mentioned, you want to make sure you don't make any public announcements or even put any job postings on the website or sign any lease agreement prior to negotiation. Once the ink is dry, it's too late to negotiate. And often in time, we see companies having to file a construction permit in advance, maybe a year or two. Unfortunately, those permit applications are actually public information. It's usually monitored by the news reporters. So if you ever get a call from the news reporter, it's very important for legal, government affair and an outside engineering firm to provide the same response, because we have been involved in a situation where the messaging was inconsistent, which created some issue during our negotiation process. So in addition to credits and incentives, when you're looking to expand and relocate, you must also consider a couple other site selection factors. So you work with a real estate firm to look for available site that suits your requirements. You want to analyze the labor pool, demographics at the proposed sites and also the surrounding areas. You also want to take a look at the community characteristics. You want to make sure your company culture is going to be a good fit in the area. And also transportation is also a very important factor. How far do you want to be from a seaport, from an airport, from a 2-lane highway, 4-lane highway? Where are your customers located? Do you want to have rail access? And lastly, you must have a good understanding of the political climate, as Robert mentioned earlier, and also the tax regime at the potential sites. Run different cost-benefit scenarios before you make your final decision. So here comes our first polling question. Are you looking to expand, relocate, or consolidate your operations? Yes, we're looking to relocate our headquarters. Yes, we're hoping to expand, consolidate our current operations. No, no plans for expanding, relocating, or consolidating. We'll give you about 45 seconds to answer the poll. It doesn't look like we have any questions in the chat box, but if you do, please feel free to enter your question in the Q&A window. Okay, here are polling results. About 4%, yes, we're looking to relocate our headquarters. About 19%, we're looking to expand or consolidate our current operations. 77%, no plans for expansion.
Great. Thanks, Melinda. We're going to get into statutory credits now. So discretionary credits, again, are something that you negotiate usually with the state, local government, county, etc. Statutory credits can be differentiated from discretionary incentives, and that if a company meets certain qualifications, it's going to be entitled to the credit benefit. Oftentimes, a tax credit form will be filed with the company's income tax return, showing that the company qualifies and calculates the amount of credit the company is entitled to. The two most popular state statutory credits will be the jobs tax credit and the investment tax credit, especially in the Southeast. Tennessee, Georgia, South Carolina, and Virginia offer robust jobs and investment tax credits with substantial benefits to eligible taxpayers. Other examples of statutory credits include state R&D tax credits. The R&D tax credit on the federal level was addressed in a virtual summit session earlier. Oftentimes, the state R&D tax credit will utilize or piggyback off of the federal R&D credit. It may be a payroll withholding tax credit, training credits or retraining tax credits, and location-based credits. And that's not to mention other types of taxes, sales and use tax credits, and then there's also pollution control, recycling, property tax credits. Benefits can range, of course, from state to state and across the board, with some states offering a one-time $500 credit per new job created, while companies located in certain counties in South Carolina may earn $125,000 per new job over a 5-year period if that job is maintained. Next slide. All right, so job creation and retention credits. So many states only allow certain companies or companies that are performing certain operations to qualify for job creation credits. Most often this is going to exclude retailers. So if you are a manufacturer, if you are in warehousing and distribution, processing, technology. If you're not public customer facing, you will often qualify for these credits. So just be careful that you are performing qualified activities to claim the jobs tax credit. That said, a number of states have kind of got certain industries or pressure probably from certain taxpayers that have allowed for some leeway in those regards. So it's always worthwhile looking at that carefully. Usually the job creation requirement is a yearly average. So you look at your base year at the jobs you have currently, and then there's a minimum job creation requirement in the next year. Usually that job creation requirement has to be met in a single year, and oftentimes that will open up a credit window in which the jobs tax credit can be earned year over year for say up to 5 years, as the case is with Georgia and South Carolina. Certain states do require pre-approval, however, so although it's generally a statutory credit, just make sure that if you're in a state that does require pre-approval, that you are checking those boxes and getting those forms filed in a timely manner. And again, usually you can only claim credit on those jobs if they're maintained from year to year. Usually it's not tied to the specific individual or the specific job, but it's a net average year over year. Some states do have clawbacks as well. So if you're claiming credit on jobs that are not going to be around in the future, have a planned obsolescence, just be careful there. All right, that brings us to polling question number 2. All right, have you created jobs in the past 3 years or have plans to create new jobs over the next 2 years? You can choose no plans to increase the workforce, created or have plans to create a few jobs, created or have plans to create more than 25 jobs. We'll leave that open for a few minutes, for a few seconds anyway. While the polling question is up, I'll mention a few new tax credits that have been implemented recently. Maryland, for tax year beginning in 2022, there's a state credit which piggybacks off the federal work opportunity tax credit, or the WOTC credit as it's more popularly known. So if your company is taking the federal WOTC credit on workers in Maryland, they can also claim a state credit for up to 50% of the federal WOTC credit. All right, the poll is now closed, and it looks like 42% of the participants chose no plans to increase the workforce, whereas about 44% do plan to create new jobs. And then about 14% are creating a substantial number of new jobs, that 25% number or 25 job number. All right, I'm going to touch on a few other additional new credit opportunities. So beginning in 2023, taxpayers creating jobs in the wind power sector in Massachusetts may be eligible for an industry-specific jobs tax credit or investment tax credit. So if you're a certified offshore wind company, you may claim a credit equal to up to 50% of your total capital investment in an offshore wind facility. And then a certified offshore wind company claiming the credit must commit to the creation of 50 net new permanent full-time employees in Massachusetts. And that credit can be is refundable as well. Excess credit is not available to be carried forward. Virginia is offering a $500 per new green job credit. So if a new green job is paying at least $50,000 in annual salary, that could qualify for the credit on an annual basis. The green job means employment must be in industries related to the field of renewables and alternative energies generally. Louisiana recently extended its R&D tax credit through the end of 2029. So it was previously set to sunset at the end of 2025. And then last but not least, South Carolina last year created a new credit for hiring veterans or previously incarcerated individuals. So taxpayers who hire a veteran of the U.S. Armed Forces or a previously incarcerated individual as a new employee in a registered apprenticeship program that has been validated by the U.S. Department of Labor may qualify for the tax credit. And the great thing, if you are an eligible employer with these types of employees, it can actually be taken, the credit can be taken against your corporate license fee, which is often very cumbersome in South Carolina. So these credits are available for employees hired January 1st, 2022 through December 31st, 2026. And the credit is first earned in the year that the veteran or previously incarcerated individual completes their 12th consecutive month of employment. So 2023 would probably be the first opportunity for companies to start claiming this credit. And the amount of the credit per eligible employee is $6,000, $6,500, and that's taken over 3 years. All right. So investment and inventory tax credits. So as mentioned in my example previously, investment tax credits are calculated as a percentage of the original tax basis of new assets the company is investing in. While it sounds relatively straightforward, there are often multiple applications which need to be filed on a timely basis in order for the taxpayer to claim the credit. Georgia, for instance, requires a pre-approval application be filed before the credit can be claimed on the company's income tax return. And speaking of Georgia, the state made some COVID-era changes in its investment tax credit rules, allowing the credit to be transferred from a income tax credit to a payroll withholding tax credit if certain qualifications are met. So we've worked with a couple of our clients to transfer a large amount of their investment tax credit carry forward to a withholding tax credit, which greatly sped up the amount of time that they could use the credit. So the transfer application must be filed between May and June of each year, and the amount of the credit to be transferred is subject to proration. That's based on a total $10 million the state has eligible for transfer, and it's prorated based on how many taxpayers apply. So this past year, the proration percentage was 86%, which was great because that means that most of the clients are getting their withholding tax benefit, and for anything that was not transferred over, they get to keep as an income tax credit still. So, and just kind of add a cherry on top, the companies are normally limited to 50% of their income tax each year when they're applying their investment tax credit, whereas when they're using it as a withholding tax credit, there is no 50% limit. So not only are you going to use that more quickly, assuming that you file your payroll taxes on at least a monthly basis, but you're going to use it much more quickly than if it were an income tax credit with its 50% limitation. Just to keep everybody aware, 2024, the May through June window, is the last year to request the transfer of excess Georgia investment tax credit to payroll withholding. So if you are in a situation where you qualify for the Georgia investment tax credit, even in the last 3 years, but you can't apply it for whatever reason against your income taxes, or maybe just to have limited amounts, please reach out to us.
Nick, can you talk a little bit about the process on applying for that? I know it's it's a tedious process, and just share high level how you got the 2 clients approved.
Yeah, absolutely. So there are certain rules depending on when the assets that the company purchased and qualify for the normal investment tax credit. There are rules for if those assets were purchased before 2020 and after 2020. If the assets that you're claiming credit on originally were purchased prior to 2020, and say you have a large investment tax credit carryover as an income tax credit that's still on your books, you do have to meet certain additional qualifications. You have to have facilities in certain counties, and you have to have a certain number, 100 employees that qualify for the jobs tax credit, although you're not taking the jobs tax credit on those employees. And you also have to have invested between $5 and $10 million total in Georgia, or plan to. So if you either have accomplished those or you plan to do that, you can apply for transfer for your older ITC. If your assets that the ITC was generated on were purchased post 2020, it's a little bit easier. All you have to do is basically submit the pre-approval application, and then there's a second application once you're approved and the proration happens to move that tax credit from your income tax account over to your withholding tax account. But everything needs to be done within that the pre-approval needs to be given within that May to June timeframe. And then as soon as you meet the qualifications, depending again on when your assets were purchased, you need to file that withholding transfer that transfers over the pre-approved amount to your withholding taxes.
Thank you, Nick. So there's a question, can any of these credits be transferred to another entity? So unfortunately, you can't transfer to another entity. It has to go to the company that has the withholding account.
Yeah, I'd say there's maybe an exception when there's some related entities occasionally, but when the company can assign Georgia tax credit or investment tax credit in some certain situations, but on the whole, yeah, that's usually not an option for these statutory credits. So that's the investment tax credit, again, popular in many states, Georgia, South Carolina, Tennessee, Virginia being some of the most prevalent ones. A handful of states offer inventory tax credits, which is essentially a dollar for dollar state income tax credit for the amount of local property taxes paid on the company's inventory in the state. So in essence, the state is basically subsidizing the local governments by offering an income tax credit and then adding a burden to the company to actually claim the benefit on their state income tax return. So just a side note, many states do not allow for local property taxes on inventory at all. So if your company is in a state with an inventory tax, Louisiana, Kentucky, West Virginia, Mississippi, or New York, definitely take a look at your income tax returns and make sure you're claiming this credit. We often find this is overlooked and there's a refund opportunity, especially if we can go back a number of years to claim the credit. Robert, I think you've had some success claiming some prior year inventory credits recently.
Yeah, thanks, Nick. Yeah, we had a client that was actually out of Louisiana. Like you mentioned before, it's commonly overlooked. So this was a credit that they overlooked on. Louisiana has a 3-year statute of limitation, and it's kind of strange how it starts. It starts on December 31st of the year that the return was filed. But we were able to go back 3 years for this client, and then also do their current year calculation. End up getting them about $170,000 back in credit based off of taxes that they paid on their inventory on the property taxes. So
the Louisiana credit is actually refundable if the total property tax in Louisiana is less than 500,000. So that they apply in this client situation. So we're able to get a big refund back for them.
and that brings us to polling question number 3. So have you invested more than $5 million in capital investments at a single location in the past 3 years? So A, yes, and we have taken advantage of the tax credits. B, yes, we have not explored if we qualify for any tax credits. And then C, no. I'll give y'all about 45 seconds there to answer that.
So we had a question pop up in the Q&A. How can you monetize tax credits? So a lot of these credits that we're talking about can't be monetized in the classic way that we would either transfer or allocate those to maybe a marketplace who would then sell those credits. Jobs tax credits, investment tax credits, et cetera, are often limited to the company earning them.
All right, we have our results here. So about 75% of y'all said no, 15% yes, they have taken advantage of the tax credits, and then 10% have not explored whether they qualify for tax credits.
So for that 10% of people, feel free to reach out to us. We'll be more than happy to do a free scoping for you, help you identify any credits and sense of opportunity, and help you negotiate them as well.
Great. So a number of states offer location-specific credits, usually as part of a program to revitalize a certain part of the community. They might call these enterprise zones, opportunity zones, or some other such names. Not to be confused with federal opportunity zones, although oftentimes they overlap. These zone credits usually are in addition to or amplify credits the company already qualifies for, as a bonus for locating or creating jobs in certain targeted areas. Virginia, for example, offers a job creation grant and a real property grant for companies which locate in a Virginia enterprise zone. And sometimes the zone is mapped to include one side of the street and not the other. So companies should definitely be aware of and think of these additional benefits when making site selection decisions. Again, there's oftentimes resources available on state economic development websites with maps, and a lot of them use pinpoint address lookups, so you can easily find some of that information, and it should definitely be considered when making a relocation. And although we focus mostly on state credits and incentives, we also assist taxpayers claiming federal location-based credits, such as the Federal Empowerment Zone credit, which could be worth up to $3,000 per employee working and living within a federal empowerment zone, and the Federal Disaster Zone credit, which can be worth up to $5,000 per employee. Additionally, there are other credits available at both the federal and state levels that reimburse certain costs. Probably the most popular of these credits would be the federal alternative fuel tax credit. If you're using propane in forklifts or generators, or you're using diesel and other off-road activities, you may be able to claim a 50 cents on the gallon for some of those. There's also apprenticeship tax credits, health and child care tax credits, and many others. I think Robert was going to share some more about the training credits. Robert?
Thanks, Nick.
Robert, before we get there, do you want to talk about a little bit about the federal disaster zone projects we have worked on? There's a couple of them.
Yeah, so definitely with those type of projects, we can help out with that. The popular one that's going away this year is any of the federal disasters that happened in 2019. So there is a limited window in order to still claim those. But what we do here is, a lot of times companies will say, I was not closed, or I wasn't really impacted. I didn't have no damage by this, by that actual disaster. But there's multiple ways you can actually qualify for that. And what we do here is we look at different things. So it's not just, did you sustain damage, but it's like, were you impacted because of the community? Did you have financial impacts? Did your suppliers have impacts, your customers, vendors? So what we do is we go through and look at all of these different things in order to see if you actually qualify for that potential credit. Anything else you want to add on that, Melinda?
No, that was good. Thank you.
And then here, talking about the training benefits, as Nick mentioned, the apprenticeship, we'll get into that, but here we either have dealing with training grants or apprenticeship grants. These can also be credits, but most all these have to be approved. And we partner with you have to partner with the technical colleges on a lot of these. So like with Georgia, you have the Quick Start Employee Training Program. Virginia has a Virginia Talent Accelerator Program. And then South Carolina is like a Ready South Carolina Training Program. And also they have an apprenticeship program. All of these are customized. So based on your company, your needs, what type of training you're doing. You partner with the technical college, we work with them. They'll help you with the recruiting and attracting workers, and then also pre-screening the candidates. And then as far as actual training itself, they help develop all that training for you and work with you on that. And then you get the approval and the benefit of taking that either as a credit or it's a grant that is issued. And that takes us to polling question number 4. So are you interested in training credits or training reimbursement grants? Yes, already taken advantage of this. Yes, tell me more. Or C as in no. About another 20 seconds here. Okay, and here's our results. So 70% of y'all answered no. 20% yes, tell us more. And then 10% of y'all has already taken advantage of this. All right, now that you have a good understanding of credits and incentives, Melinda will go over questions to ask when scoping for these type of credit and C&I opportunities.
Thank you, Robert. So there are a lot of good questions you can ask when you're scoping for C&I opportunities, either within your organization or for your clients. So as Robert mentioned earlier, depending on the stakeholder, the question may be different. So for legal government affairs, you want to ask them, are there any planned business events, any M&A transactions, any corporate restructuring in the horizon, or any inbound investments? So I do want to mention that if you have an asset acquisition, sometimes the state would allow you to treat property and employee as if they're new to the state. But usually you have to negotiate with the state or get an approval before you can receive any C&I benefits. And the question for a real estate would be, are you investing at least $5 million or adding at least 25 new jobs at a single location? And for tax planning, tax compliance, have you paid tax in the past 3 years or plan to pay tax over the next 2 years? Are you under any federal or state audits? Is the company investing in new processes, new projects, or developing new products? And lastly, for operations, are you using any alternative fuel, propane, diesel, gasoline for off-road purposes? And as Robert mentioned earlier, was your business impacted by a major disaster that could qualify for a disaster credit? So there are a lot more questions you can ask for to scope a C&I opportunity, but just remember, most C&Is are tied to people and property. So next, we're going to talk about what type of information do you need to look at to scope the C&I opportunities. So for discretionary incentives, you'll start with the capital budget, ideally by location and also a headcount projection. And so that way you can roll through the capital budget and figure out, what state you're spending money in. And if you already have incentives agreement in place, you will need to factor in existing project commitment, make sure you're not overcommitting yourself on the next project. And if you're looking at multiple different sites, you want to make sure you have a clear timeline, as Robert mentioned earlier. Define your location requirements and prioritize your decision-making factors. According to a site selection survey of real estate executives in 2022, as expected, the number one factor is workforce skills. Since there has been a labor shortage and high turnover rate, that has been the number one issue for a lot of people. In 2022, the average turnover rate was about 47%, with manufacturing turnover rate at 39%, professional services at 63%. Compared December to 22 years ago, 2020, the average turnover ratio was about 57%. So the number 2 factor is tied between state and local tax regime and workforce development. Skipping number 3, number 4 is transportation infrastructure. Number 5 is ease of permitting regulatory procedures. Number 6 is a tie between land building prices and supply and utility cost. And number 8 is a tie between incentives and higher education resources and quality of life. So incentives have actually moved up 1 spot. It was ranked number 9 in 2020 survey. So for statutory credits, you will need to have a list of physical locations so you can identify location-based credits that Nick talked about earlier. And then have 3 or 4 years of federal and state income tax return and work papers so you can look for retroactive refund opportunities. And also have a list of open audit where you can find credits to offset your potential exposures. And work with HR on employee data. And also request a fixed asset listing from the business units so you can look for investment tax credits. So these are all the information you can review to identify C&I opportunities. Cash is king. Secure state credits and incentives will increase your return on investment, also increase your cash flow. And that concludes our session. Thank you for joining us. If you have any additional questions regarding today's topic, please feel free to reach out to Nick, Robert, or myself at any time. We specialize in state credits and incentives and site selection. We're happy to brainstorm ideas with you. We value your feedback and ask that you take part in short survey that we will be sent to you after this session. Thank you again for joining us during our 2023 Tax Credits Incentive 2-day virtual conference. We hope you found this information useful and look forward to hearing from you soon. Thank you.